Holy smokes, we've got a researcher calling out Jerome Powell as a wannabe and as somebody who will never make it to the grandeur of being known as the Paul Volcker of the world economy. And essentially, they don't seem to trust that Jerome Powell is going to give us the medicine that we need. And so this is a piece by Jefferies, Mr. Christopher Wood over at Jefferies. And I'm going to go through some of the pieces here with you. I'll go through their intro, and then I'll go through their critical commentary, and then, of course, I'll add my commentary. So let's get right into it. Washington power plays aside. So this is where they actually start by talking about Lael Brainard leaving. And the reason they touch on Lael Brainard leaving is because she was your primary dove at the Fed. And now the sort of cheerleader of the doves is gone at the Fed because she's going to the head of the NEC, the National Economic Council. Think about basically Lael Brainard replacing Larry Kudlow. We're going to have a V-shaped recovery. It's going to be huge, a huge V. And that was your Larry Kudlow. And so Lael Brainard is leaving. She's essentially your pure dove. So now you have a Fed that's positioned potentially more hawkishly. But the Jefferies piece here makes a counter argument to the potential hawkishness of the Federal Reserve. So let's take a listen here. Power plays aside, the departure of the leading dove at the Fed, as well as the most articulate and economically literate one, huge slam on everyone who's left at the Fed, by the way, does raise a risk that greed and fear will prove to be too complacent on the current view here that it will be surprising. Greed and fear, by the way, is this piece here. Anyway, the current view here that it will be surprising in the extreme if the Fed does more than one rate hike. Indeed, money markets are now discounting another 65 basis points of rate hikes to 5.23% on the Fed funds effective rate by July, up from 4.89% on Feb 1, above the previous peak terminal rate of 5.15% reached in early November. And because Brainard, the dove, is going away, there's this market belief that the Fed is going to be more aggressive. So trying to translate this to English, basically they're saying, hey, look, we think the Fed's not going to be capable of hiking any more than one time. They're actually kind of like the Fed is not going to have the balls to raise any more than one more time. You'll get another 25 BP hike, and then you're going to get a pause in May. That's what they believe. Now, by losing Brainard, they're sort of hedging a little bit, and they're like, all right, maybe we'll get 2 more 25 BP hikes. But they're not believers that the Fed's going to be able to pull off getting to above 5%. And the first thing they do is they throw up this chart here showing average hourly earnings growth. And they show how average hourly earnings growth is plummeting. And they suggest that this plummeting of average hourly earnings growth will actually force the Fed into a dovish posture faster. And keep in mind, that's kind of what we've been seeing, right? You have companies like Tyson Foods saying they're good with labor availability. You have less signing bonuses going into healthcare, which we're not quite clear how that's going to show up in indices like employment cost indexes, whether they actually show up and show signing bonuses going away, which signing bonuses going away is essentially a wage reduction, right? And it's kind of like you get a first free month of rent when you rent a place at an inflated wage. It kind of makes it feel like rents are higher than they really are because you've been subsidized by, if you get a free month of rent at $2,400, that's like getting $200 off, right? So now your average rent should actually be $2,200, not $2,400. But then it looks artificially high but you've been subsidized. That sort of same thing in reverse when your signing bonuses go away. And so that's because you would get paid, say $10,000 more per year. So your salary might be $100K as opposed to $110 with the bonus. You take the bonus away, your wage actually goes down. But does that actually get reflected? Because it might look like, a $100K person is still making $100K. Who knows? Anyway, so in other words, myself, I'm seeing in the healthcare industry, as well as statistically, we're seeing less signing bonuses, less pressure, easier availability to find workers, more availability to find workers at Chipotle, Starbucks, entry-level workers, so on and so forth. So you're not actually seeing, you're seeing more labor availability at Cloudflare and software services, more labor availability at Uber and Lyft. You're not seeing the wage price spiral that you were seeing in the 70s. No leading indicator is suggesting that. So if you're making a short bet on the market because you think there's going to be a Paul Volcker regime coming, you might be sorely disappointed. Anyway, continuing with the piece here. Brainard has been articulating clearly the view that monetary policy works with a lag, but unfortunately she's gone. Now, right here, you're saying, just let me read you this because it's hilarious. In this context, on Brainard's departure, Powell may have more room to maneuver to play out his current wannabe Volcker act before he does the inevitable pivot. In other words, this opinion Wall Street piece here is that Jerome Powell is trying to be a wannabe Paul Volcker. But in trying to be a Paul Volcker, basically by trying to be a badass, he might end up going down as someone who didn't have the best reputation, like an Arthur Burns, who ended up creating massive Federal Reserve policy mistakes. And so they're making the argument that Jerome Powell losing Brainard might make him temporarily seem like a more badass Volcker, but he's going to end up being a loser, and he's going to end up pivoting like the weenie baby they think he is. This is them, okay? They're the ones being so aggressive about Powell. I'll give you my opinion in just a moment. They believe, and it's their base case which remains, that listen to this, quote, the Federal Reserve will be quick to pivot the moment there is any evidence of real weakness in the overall labor market, as opposed to the white-collar restructuring currently being witnessed. So as soon as you see basically the normal labor market, as we already are with Uber availability, Lyft availability, Tyson Foods hiring availability, entry-level healthcare availability, all of these positions are already seeing way, way less pricing power for labor, which means wages are stabilizing. There is no wage price spiral. And they believe that as soon as the Fed realizes, we're actually starting to see those lags hit, and we're actually seeing wage weakness, the Fed's going to pivot instantly. And they're going to realize, no wage price spiral, let's pivot, let's pause on rates, let's start reducing rates. We don't actually want to see people get hurt because we have a dual mandate. Stable prices and maximum employment is the dual mandate, obviously, right? And so, of course, then they go into sort of the traditional argument here that don't worry. At the same time as we see wage price pressure go away, we're going to see CPI plummet because of inflation, and it's nearly, 50% contribution to inflation right now. That's going to plummet and disappear. And so what you're really going to see, this is their opinion, and I'll give you mine in a moment. Their opinion is that you're going to see lagging data show basically 50% of inflationary pressures plummet because of housing, and the other 50% of the inflationary pressures because of wages, as soon as there's any sign that they've hit weakness already, which between you and me, we already see the leading indicators of that weakness. You're going to see wage pressures plummet, which will plummet services inflation. In other words, the Fed is going to pivot so fast that you're not going to want to price in too much more pain in 2023. That's their opinion. I don't know if I'm as bullish as they are. So I'll try to place myself on a scale here. So if I sort of had a scale, and over here on the left, you had like a bear, and over here, you had, the two hike bull, dare I say, two hike bull and pivot. I'm probably a little bit more like right here, where I'm like a 3 to 4 hike bull, and the market will get through it. It'll take a little longer to get to that sort of inflation, but that inflation is coming. It's just going to take longer. So I agree with the higher for longer narrative, but I'm definitely leaning more on that bullish side. That's why I'm like, all in, but I'm not in that place where I'm like, let's see YOLO call options, right? But I'm also not anywhere near this sort of bear side. But I think this is very interesting how they basically call him a weenie baby, and they say temporarily you might see more aggressive posturing, but in the long term, not a chance. That guy's gonna flip-flop like the greatest weenie baby you've ever seen. Nobody's ever seen a weenie baby like Jerome Powell when he pivots. So, who knows? We'll see, but that's this person's thought. Let me know what you think in the comments down below.